All right, everyone, here we are with another video with Invest for Tomorrow. To all the first-time viewers and investors, welcome to the channel. And to all the subscribers, welcome back. All I ask for in return is for you guys to smash that like button to let me know you watched this video, that you found it helpful and informative, and that you find value in the time and efforts that I put in to make these videos. It obviously takes time. I got to think through how I'm going to explain myself. You know, it's a lot easier to sit there and watch this, but I actually go ahead and analyze and think through every possibility so that we are prepared as investors. So I really appreciate it when you give me that thumbs up, you share this with a friend or someone in your community. So let's jump right into it. So the S&P 500 index, super important. A lot of people want to focus in on individual stocks. That's all they care about, and they don't even care about the market. Well, when you are buying a stock, you are in the market. The market is bigger than the stock. Now, there are times where an individual stock can outperform the market and do its own thing, but at some point, the market will always be bigger and do something bigger or outperform at some point in the long term a stock's potential, right? Like the way it works. Now, I know a lot of people say, well, no, the average return. I'm not talking about that. I'm just talking about the way the system works, because there's very few stocks that can create this pattern, and we're about to look at it, okay? If you can find a stock that can create this pattern, it's probably going to be a handful. A handful, I promise. Very few stocks out there that can do this. And there's like 7,000 different ticker symbols. You'll probably find, less than 1,000, but just a few hundred. And then when I say a handful, it's a lot, but a very small percentage of the overall entire market. This is what the overall market does. It goes up. That's where that saying says stocks only go up. Yeah, that's what they're talking about. This is what they're talking about. From here to here, right? Now, this is years and years and years of investing and years of obviously stocks growing and companies growing, and also the stock market becoming more and more accessible to individuals. I mean, way back here, the stock market was like private here as well almost. And things in technology were starting to change. And here we are seeing the potential of the market with all the technology that we have and the accessibility. So let's go ahead and look at this. And I want to share with you guys some important things. I want you guys to be aware of something. So the first thing is worst case scenario. Okay, I'm going to give you guys the ugly. Worst case scenario, that we break through 3,700 and we could possibly hit down here to 35 or even as low as 32. Worst case scenario. Okay, I want you guys to be aware of that. Worst case scenario, if we pull back and we keep going down and we break through 3,700. I think personally that we might have a nice support between 37 and 36. If we get that low, we won't even touch 35. Again, this is my opinion. I'm not a financial advisor, nor do I give financial advice. I'm not here to tell you guys to buy, sell, or hold any positions on any stocks, but I do like to share my opinion, and it seems to me, based off of all the subscribers and viewers, my opinion matters to you guys and you find it insightful. So I'm really excited and I enjoy sharing all this knowledge, opportunity, research with you guys. So 3,700 is like the ugliest of the ugliest. And then getting down to 37 to 35. Ugliest. I don't think 32, but that's like way too bad now. Like things got real ugly. But let's just say 37 for now. Worst case scenario, 37 to 35. But you always want to keep these numbers in mind, written down in the back of your head, just in case. Now, this is the bad. Not the ugly, but the bad. The bad is that we keep having some volatility spikes and we're going downwards and then we kind of just end up sideways. And this turns into being a resistance that even if we get close to it, we get rejected again and we fall down again. So if we keep going through this type of volatility, which is kind of doing a confusion to investors, and a lot of investors believe that, the stock market is this easy, it just goes up. Not true. If you are a 2020 investor, I just want to be honest with you guys. I'm speaking from experience, and I learned a lot back in 2018 and even before that. The stock market can get very volatile and it can get very confusing. And in the times that we're in right now, the stock market is more volatile than ever because of the readjustments to the new modern society. I mean, like, it's almost like we're changing things around. Like social distancing has become like a norm. Like, even as we get out of this, restaurants aren't going to fully recover 100%. Airlines aren't going to fully recover 100%. Like, look at all the things going on outside of the US, right? There's been a big transition in our society, culture, and the way we do things. And some stocks are going to do better than others. But I have an article here that can share with us also some insight, which I found interesting. I really like how they explained everything. But back to this. These dips here and this volatility, that's what you want to focus on. You want to avoid these highs. And I know it's easier said than done, but you're going to learn how to do it the more times you see it. Okay? Like right here, you had training for like 8 different dips and 8 different highs. Okay? And then on this way up, you've had like training for like 5 different highs, right? And then like 5 different dips. Like, look at these dips, all these dips. The more you train yourself to catch these dips or understand these dips, the more equipped you're going to be prepared for the uncertainty and not be surprised, right? So this is the bad. The ugly, we already explained it, the bad. So let's go ahead and look at this article. So this article here says, right, how there's a shift in the market sentiment. While the initial rebound was driven by low rates and stimulus, now stocks have been guided by optimism around the rollout of the vaccine and reopening the economy. This can be seen by the rotation from stay-at-home tech stocks into stocks that hinge on reopening, like travel, entertainment, and names. So I just said everything about airlines, being a little bit hurt, travel and stuff like that, entertainment. I think this is going to be like a temporary phase. Once reopening kind of gets to normal, at some point, I'm not going to say it's going to be dumped completely, but some of these stocks, there's going to be a transition. Like, it's just, getting the hype, getting the speculation, and coming right back into what actually makes stocks grow and what part of the stock market is booming, which is tech. And not everything stay at home, but some things will have its potential still. So the S&P 500 has now gained 76% since its lowest point 1 year ago. Today's like the 1 year anniversary. Like, you can look up the S&P 500 index and you're going to see like a whole bunch of articles talking about that. The analysts expect the next leg of the rally to continue to be supported by stimulus and accommodative policy from the Fed, but they also see economic growth driving the market higher. So, reopening, inflation, right? The Fed is saying it's going to be temporary. We're going to see volatility in the market. It could be sideways. It could be downwards. That has a lot to do with the bad that I just drew out. So once we get over that hill, there was going to be opportunities at the dips to catch your fair share of the stocks you want. Okay. Now, every single investor also needs to be prepared for, like, I'm not trying to do a swing trade or a day trade here. This is more of like investing. Investing is 6 months to a year. That's like literally what investing is. And anything below that is short-term investing, which is close to scalping and swing trading and day trading. That's not investing. Those are investing strategies. Now, here we are with what the Fed says. Okay, so economic growth, though, is going to counter the whole inflation, and then there's going to be stocks running up because economic growth. So there's going to be some type of like back and forth, swinging all over the place. But at some point, we're going to stabilize and then grow on out from there. And that's what I want you guys to keep in mind. As long as we don't break through the ugly, which is 3,700 to 3,500, worst case scenario. And then it can go even worse, but we don't want to think about that now. We just want to be aware. Now, in the end, the most supportive factor will be the reopening of the global economy. We have the cure, the vaccine. I wouldn't say it's the cure. I would just say it's a way to minimize the spread, but that's not the cure. The vaccine can only help so much, but it's a big step forward, and I'm excited about it for the world, the community, and the country. Now, once we can reopen the global economy, we will be left with massive stimulus, healthy corporate and consumer balance sheets, and substantial pent-up demand. this should lead to a multi-year acceleration in economic growth. That right there is what I love the most. And that's what every single article, when you look up about the S&P and the overall market, a lot of articles like Bank of America already put a price target on the S&P 500 of 4,200. Worst case scenario, and best case scenario like 4,500. There's some saying 5,000 we'll see by next year. So once we get through all these hurdles, reopening, this and that, and like things are starting to stabilize, the S&P 500 index is giving you deals now that you won't see tomorrow. And let me show you a perfect example of why today the stocks are worth less than tomorrow. So I'm going to share that with you guys. But before I do, the 10-year Treasury has finally shown detachment from the stock market. It's been going downwards, and the stock market has been going downwards. You can see it right there, going downwards. So I find that interesting as well. We're finally getting some detachment. It's looking healthy, and we need to see, because the worst thing that could happen though is that this spikes up again crazy like it's been doing. Like, I mean, honestly, it just jumps out of nowhere. And then when these spikes happen, you kind of get caught by surprise in the market, and then the market pulls down even harder. Because those hardest pulls here, these pull downs and pullbacks, have a lot to do with the spikes that were happening on the way up. Now we're finally going back down. Hopefully this doesn't get crazy and spike up. We hit 1.7. Hopefully that is the peak and we go downwards, right? So very interesting to me, but let me show you guys why today is more important than tomorrow. So here we are with a spread out perspective of the S&P. Let me see if I put the 1 day and it looks better. I think this looks better. So this was once today, and this is what I want you guys to catch on to. That was once today. This was once today. This was once today. This was once today. And this was once today. What do I mean by that? Every single time, this was once the present time. And when you bought at any of those present times, you would be, no matter what, right? Let's go ahead and draw these out. You would be, no matter what, right? Upwards. No matter what. Because once you made that decision today, whenever today was, you would be up. Now, a lot of people are like, well, what if I make the decision today? It's kind of funny to think like that. Today, right here, and I end up down here, right? Worst case scenario. And you end up down there. Well, you need to think about it this way. This is your next today, and everything above, on the way back up is today. And when you look out into perspective, you will probably be that guy that bought right here, and then you kept buying, and you kept buying, and you kept buying, and then, you probably bought here, you kept buying, and at some point, your todays are left in the past, and then this is the future, which is the present time that we're in right now. We are in the future of yesterday's todays. Today is the best price right now before the prices get higher. I hope this makes sense to you guys, but one thing I am seeing is the stock market having so much room to be explosive right now, especially with rates being promised basically to stay below those levels, right? Being at the lowest levels until 2023. And I think that 2022 and the second half of 2021 are going to be so explosive once we get through all this turbulence that every single pullback was an opportunity, and the ones that didn't feel comfortable enough or ready missed out on it. And we're going to look ahead. I could be completely wrong, but today's prices will always be cheaper than tomorrow's. That's why we invest for tomorrow. This was a today once, and that's in the past. This was a today once, that's in the past. This was a today once, that's in the past. Today is going to be a today once, it's going to be left in the past. And we're going to see that it's going to have the same effect. At some point, that today was way back here, and we're going to be way up there at some point. As always, guys, thank you guys so much for watching, and let's make some money.